What is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to do some stock analysis for Amazon stock. The reason I picked this stock today to analyze is I am a shareholder, but not only that, but if we go to dataroma.com to see what super investors are buying, we can see that Amazon is one of the top picks with 10 buys for the last quarter. And so if we look at the stock chart here, we can see in the last 5 years, the stock's up 86%. So it actually is underperforming. I believe it's about matching the S&P, but it is underperforming the NASDAQ. And that's because, as we're going to get into here in a little bit, their free cash flow, net income, a lot of their financial metrics have been weaker in the last 2 years. I think one of the big drivers of that is probably their investment in Rivian. I think that cost them a lot of money for some time, but I think they're kind of over that now. If we look at the last year for this company, it's up 56%. So there was definitely some money to be made here. The stock was $80 and now it's 146. As you can see, I own 35 shares. I actually sold a couple shares recently just because this position had gotten too big. And part of the problem was I bought this stock way too soon. I think when the stock was $170, $180, I was really eager to buy it. So as soon as I saw it dip, below 160, I started buying, and I thought that was a good price. But, obviously it dropped a lot more after that. So whatever, that's in the past. I think Amazon now, within a year or so, I think the stock's going to keep going up as we get into their metrics here and the current valuation. I think there's plenty of room for this stock to keep running. Other than that, Amazon is a $1.5 trillion company. It's always traded at a pretty rich PE ratio. I think most people know what Amazon does. They own a ton of different companies, so they're pretty much involved in almost every sector. But the first metric we're going to look at here is going to be their revenue trend. And this one I gave a check because they're growing on average 23% per year for their revenue. And this past year, they did $513 billion. Not many companies out there that are doing $500 billion of revenue in 1 year. But Amazon, a little bit over $513 billion last year. And I wouldn't be surprised if let's see, we can look at what they're doing for the past couple of quarters. The past couple of quarters have been strong. We're talking about $143 billion of revenue for a single quarter. So that will get a check. As for net income, we go down to the net income chart. This is where things get a little bit weaker. For this, I guess we can keep it on quarterly. For this, you can see that things spiked in the end of 2021. And then just these last couple of quarters, we're starting to get back to new highs and get back to where we were a couple of years ago. So that's good. The last quarter, they did $9.8 billion, which is a lot. And then hopefully this next upcoming quarter, it'll even be more than that. And then they're also growing at about 27, 28%. So that will also get a check. I like what I see there. Then we get to the price to earnings. This one's interesting because Amazon's one of those companies that's always traded at a very high PE ratio. This is actually, this stock is a great lesson because the normal things you would look for in a company, in a stock, Amazon is a little bit different. So most people know Amazon is a huge success story. And over the last 20 years, there's a lot of money to be made in this stock. If you go back to 2001, 2002, the stock was under $1. The stock was 70 cents for one share. Now the stock's $146. So the stock's up over 4,000%, right? But a lot of these metrics are a little bit weaker than what I would normally accept for a company. But if we go to the PE ratio history, what we're going to see is before these years, I mean, just the last probably 5 to 7 years is when it actually makes sense to look at their PE ratio and profitability, because before that, 2010 to 2015 or so, they weren't profitable. So it wasn't, there's not much to analyze there. But if we go back to we could even put this back a little bit more, but the PE ratio was higher. See, if you go back to 2017, it traded at, over 200 times earnings. So that's not really very realistic. The more reasonable ratio to see this trading at is somewhere around 70, right? Because it's dipped down to 50 and it's been as high as 100, but it pretty much likes to hang around this 60 to 70 range. So we could say 65 times is fair. Sounds like a lot, but for Amazon, I would say it's fair. And so if we look at what numbers they're going to do for this year, as far as EPS and profitability goes, this past year was actually negative, right? So that's why this is Amazon stock kind of suffered a little bit. And that's why the PE ratio may look high, but because they actually had negative EPS for last year, which again, I think it was not only were we kind of going through just recessionary times, but also the Rivian investment cost them some money. But this year they're doing $2.45 of EPS. Now, also keep this in mind as well. This is something that is good to pay attention to. What do they normally miss earnings or beat on earnings? Because we don't know how realistic or how accurate these EPS estimates are going to be. So, for example, so go back to 2022, which was a bad year for them, right? They missed by 82%, which is a lot. That's really bad. But you look at these other years, they beat by 47, or these other quarters, they beat by 47%, 85%, 59%. Those are really big beats. Those are really impressive beats. So if they can do anywhere near that, I mean, if they can beat by 20%, that'd be an accomplishment. So we can almost, there's a very likely, high probability that these numbers will come out actually a lot bigger. So I think, 2.4, 2.5, 2.6 that of EPS for this year is probably on the low end. I would not be surprised if they did somewhere closer to 3. And then same thing with 2024. I wouldn't be surprised if they did some EPS closer to $4 of EPS. There's a very good chance of that. But let's just say we use these numbers, very conservative, very low estimates here. $2.45 for this year. We're looking at an EPS of 58 times, or I'm sorry, a PE ratio of 58 times for this year. Next year, 44 times. Compare that to the average. We just looked at the chart. It's normally trading at, 55 in the very low end, but really like 65, 75. That's a typical trailing PE ratio for Amazon. So when you look at it like that, when this year's over, this stock should be easily $160, right? Around January time. No, January, February, this stock should be $160 because 65 times $2.45 EPS is 160. And remember, that's only if they do $2.45 of EPS. If they beat that, let's say they come in with 2.7, okay? Very realistic. 2.7. Now the stock should be about $175. Okay. Now let's stick with our conservative estimates, conservative PE ratio, and let's say for 2024, 65 times 325, $211. Okay, that's for going into 2025. That's what the stock should be. So there's still money to be made here, even though the stock is up 56% this year. There's still money to be made. Would I be buying right now? I mean, I'm not going to buy because I have enough shares. This position was too big to begin with. So I'm looking to sell some shares. I definitely want to wait till the stock goes up a little bit, at least 160, 170, 180. Then I'll make my position a little bit smaller. But once the position is down to, something more reasonable, like 5%, 6% of my portfolio, I would like to hold this position until it goes to $200 or $250 a share over the next year or two, because I think that's what's going to happen. So are they innovative? Yes. You can look up all the different brands and companies they own. They have Whole Foods, they have Twitch, they have all these different things. They have AWS, which seems to be the main growth driver for this company, but they innovate in a lot of different ways. Is the market share strong? Yes. Once again, they're involved in a lot of different things, but their e-commerce and AWS is two of the most powerful things, and the market share is strong in both of them. But now this is where it gets interesting, okay? So this is what's important to pay attention to, is that sometimes you can have stocks like Amazon that are up 4,000% in the last 20 years, but their numbers are not that strong. Now keep in mind, too, it's up 4,000%, and we're talking about Amazon just turned profitable. Let's see what year Amazon turned profitable. Amazon turned profitable in, let's go back here, not that long ago. So for the majority of that time, they were negative, right? They were in the negative. So 2015 was when their first positive net income came out. But from 2000 to 2015, they were losing money, and they lost money in 2022. The last couple of years have been weak too. And the stock's up 4,000% because that's because of improvement. That's because of revenue growth, and it's because of improvement in the numbers and all that stuff. But if we look at things like return on invested capital, this is not getting a check on my list because it's not over 10%. If we go to ROI, you're going to see, even, we're talking about one of the biggest companies in the world, and their numbers are still not strong. It's not like this is a startup and it's 2005. Amazon has been around now for 30 years. So return on capital employed is 4%. At its peak, 2018, it was 13%. So that's not bad. 13 is not bad. But 8% and then 4%, that's not very good. So that's not going to get a check. Equity, this is phenomenal. This part of their analysis here is actually a good thing. So let's go to their equity on the balance sheet. 60 billion, not million, 60 billion 4 years ago. Now we're sitting at 180 billion. So it's a 3x, right? 3x on their equity in 4 years. That's incredible. That's really good. So that one gets an A+. Okay. Is it over 15% of the market cap? No, the equity is not, because this is when you have companies that trade at high premiums, high valuations. Normally it's a high PE ratio, a high price to sales, and a high price to equity. That's normally how it goes. So this is one of those companies. Share count decrease. No, this is another one where it's like, it's not a make it or break it situation, but this is one where I would actually expect them to be buying back shares. Okay, you have companies like Meta Platforms or Airbnb, which are kind of similar companies to Amazon, and they have huge share buybacks. So that's one thing that's a little bit disappointing. But again, that's not a make it or break it for a stock or a company like this. That's just something to take into consideration, and it's nice and it helps out the stock if they are buying back shares, but they're not. The assets are definitely not 2x the liabilities. The margin, again, just like ROI, the margin has been bouncing around 4 to 7%. Okay. So for pretty much any other company, when I see this on any other stock I look at, I'm thinking if margin, especially return on capital, if margins and ROI are, 3%, 6%, I'm thinking, okay, I'm not that interested in this stock. If they're only getting returns of 5% on their money, I don't want to give them my money because it doesn't make any sense. I want to give my money to a company who can make me 20, 30, 40%, right? Like a Microsoft or something like that. But at the same time, Amazon look at the returns you could have got with Amazon. So it's just interesting to see examples like this. Negative margins for last year. The year prior was 7%, 5%, 4%, right? Not very strong, not very strong. Then we look at cash receivables, 107 billion, and they're normally doing what they just did, 20 billion or so in net income, right? Well, they just did 10 billion for a quarter. So I'm sure this year's net income is going to be a lot more than 20 billion. It'll probably be like 40 billion or, some 35 to 45. But the bottom line is the cash receivables are still more. That'll get a check. No dividend yet. Probably because Amazon is still growing. And then is it over 10 years old? Yes, founded in 94. Free cash flow, here's another problem, similar to net income. Negative the last 2 years. There was some growth from 2017 to 2020. This is adjusted free. This is free cash flow per share. This is adjusted free cash flow per share. So this should not always, but most of the time it follows the net income trend. But overall, my take on this is that it's a good example of a great stock you could have invested in, but that don't have great financial metrics, like what I'm looking for in other companies. And that since their EPS is going up so much this year and the next year, and probably the years to follow, there's still a lot of room for this stock to run, even though it's a $1.5 trillion company, and even though you're paying 43 times forward earnings. Okay, well, you're supposedly paying 43 times earnings, but like I talked about, there's a great chance that this company comes in and beats by, whatever, 20%, 50%, could be 100% beat on their numbers, right? So then that you're not paying 43 times earnings anymore. Maybe you're only paying 30 times or something like that. So the point is there's still room for this stock to run. And overall, I'm bullish on Amazon. So thank you for watching. Let me know what you think. Comment down below what stock you want me to analyze next.